Hello, my name is Kurt. I'm a value investor, and today I'm going to review my $1 Million Challenge portfolio. And the goal of this portfolio is to accumulate stocks that are well below their intrinsic fair value, wait for them to realize fair value to make high returns, and grow this portfolio to $1 million eventually. We don't know how long it's going to take, but we're going to try to do it as soon as possible. Right now, you can see that the total value of the portfolio in the market is $12,100. But in this video, we're going to look at what stocks are in the portfolio, what is their intrinsic fair value as I've calculated them, and what can we do to improve our performance. We're also going to look at 4 great stocks that I think are undervalued, that are really good quality stocks to hold for the portfolio that you might also want to add to your watch list. So let's take a look. The stocks in the portfolio are as follows here. NXST Media is the top holding, Medifast, Ally Financial, PayPal, Mastercraft Boats, CHGG, AGRO, American Express, Alphabet, and Flexible Solutions. Most of the positions are actually at an unrealized loss right now. They're down. We don't have very many stocks that have gained, although among those are Ally Financial, NXST Media. But the main thing that I want to point out is that we've calculated the net fundamental value for these stocks. And for most of them, actually all of them, the fundamental value is higher than the current cost basis or the current market value even. So even though we haven't done so well in the portfolio to this point, we have untapped potential. We have stocks that are sitting in our portfolio that are well below their intrinsic value, and we do need to be patient and wait for them to realize that fair value. I know it seems like the portfolio is doing really bad, and I welcome all the criticism in the world, but sometimes you do have to be patient and wait for your convictions to play out. Stocks for a realized, we've sold some stocks for a realized gain. The realized profit's about plus 800 since the inception of the portfolio, but we're sitting with about 1,400 in unrealized losses right now with pretty much no cash on hand. The point of this portfolio is we add capital every 2 weeks so we can continue to compound that portfolio and buy some more of these stocks. And there you can see that even though the market value of the portfolio is $12,100, the net fundamental value of the portfolio is $29,000 almost. So if you look at it from the potential side, we're not actually doing that poorly. We're actually doing well, but we would need all those stocks to realize their potential, realize their fair value for that to play out. In the meantime, here's our portfolio performance against the S&P 500. You can see that overall, since the inception of the portfolio, the S&P has really gone up and down a lot. It hasn't been consistently up, although overall it's returned about 18-19% since August of 2022, and that is about 8% per year average return, whereas the portfolio we have on a dollar-weighted basis is about 0.5% per year, which basically flat. We've lost a little bit overall, but when you dollar weight the returns on a 2-week rolling basis, it's about flat. The point is we haven't gained much, we haven't lost much, but compared to the S&P, it's really bad because we're down 7.5% per year relative to the S&P in about a year and a half. So we need to improve the performance of the portfolio to catch back up to our schedule. And to show that schedule, I have that here. The gray line represents where we should be if we were to achieve our $1 million in 10 years performance. Now, we can catch back up to that schedule by having better performance in the future or by deploying more capital than we originally planned for. I'll talk at the end about what I plan to do to try to catch back up to that and jumpstart our returns, or jumpstart our portfolio balance rather, back up to that level. But you can see how we're basically flat, the total deposits here in the green line compared to the closing value in the purple line. At some times we've seen really high growth, but then we've lost ground, and right now we've come back to basically being flat overall. And right now we're 31% below where our scheduled amount would be. So we need to get better. We need to improve, and that's going to be obvious. And so I welcome all of your comments. Of course, you can tell me what I'm doing wrong. I think that my stock picks have been good, but we definitely need to be patient and wait on some of them. Some of them we have to cut our losses when they don't seem right. But what stocks are you looking at? What do you think I should add to my value investment portfolio to make it better? And here's a watch list that I have 4 really good quality stocks that I am looking to add to the portfolio if I have a good opportunity with some capital. This would be if I sell one of my positions or if I deploy some capital into the portfolio. NVR is a home building stock, and they've become a monster compounder where they buy back shares and their cash flow just has continued to increase. So to me, they have a 3.8 value to price ratio, which is huge, and it leads to implied annual return of 28%. That is the discount rate that balances their current price with their future free cash flow when you include their adjusted today's book value. So that derives our implied annual expected return. Cincinnati Financial is an insurance provider. Big company, it's in the S&P 500, about $17 billion market cap. It has a PE ratio less than 10 right now with a value twice as much as its current price. I see this as a long-term growing company. It can add a lot of stability to the portfolio. It may not be something that's going to go up 50% per year or give me those huge returns, but it's going to be good returns, maybe even 30%, 35% if I'm lucky. And this is also a dividend king. So it's one of those companies that's been around for a while. Even if it drops, we know long-term it's going back up again. Penske Automotive Group, they own a lot of car dealerships, but they also have their freight and logistics business, their truck rentals, and their service industry where they service vehicles and diesel trucks and all that stuff. Penske's done a lot of good share buybacks recently, and their free cash flow has really exploded since COVID. It might come back down, but we're just going to assume that even if it does come back down, long-term, it's going up, up, up. Again, 2 times its current price, that would be the value that I've calculated for it, which leads to implied annual return of 19%. Gravity Corporation, I have to give a lot of props to people on social media that have pointed out this stock to me in the last few days. I did an analysis on it, and I realized it's got 8 out of 8 pillars, which I give was like the quality of the business, how sturdy and predictable is a business. This company got 8 out of 8 on that scorecard and 20 out of 21 sub-pillars. It's a small company, less than $500 million market cap. It's a Korean video game maker, which is kind of interesting, but hey, their financials speak for themselves. I don't know everything about it. I'm going to be reading their annual reports and doing more research on the company so I can feel comfortable before buying into it, but it's something I'm definitely looking at. Right now it has an implied annual return of 38%, which is huge. And just to point out that this company specifically, Gravity Corporation, there is their trailing 12-month net earnings per share, which you see long-term trend going up. Meanwhile, the price has gone on several spikes upward, but right now it's crashed down even though their earnings per share is at an all-time high. So this is something where you could see an opportunity. I just want to point out, sometimes when you're looking at these great quality companies and stocks, when you see technical action like this, it could be an even bigger indicator that it's an opportunity to buy. We've seen in the past some cyclicality with their earnings per share decreasing and going back up, and it's a cyclical business somewhat, but long term, it has a track record of just going upwards. So when you see something like that, okay, the earnings per share came down a little bit, the price really slid down, but then popped back up, slid down, but popped back up. And right now it's slid back down. And I think the stock price has stayed down because investors are anticipating a peak in earnings per share here, and they expect it to go back down. But to me, long-term trend, upward, obvious, and we're catching it like at the bottom, near the bottom of this cycle where we've seen before. It has a good opportunity to pop back up again. So technical things like that, that's a pattern that to me is really good, and it's leading to the price to earnings ratio being under 5. And so it's really flashing those signals of, hey, this thing is something that low risk could go up a lot. And so those are the 4 companies that I'm looking at right now. Here are some action items for the $1 Million Challenge portfolio that I have in the short term. I want to add more capital to try to juice the portfolio to catch back up to where I should be in the schedule. And I really do need to make better investment decisions and combine that with being patient on some of these to wait for them to turn around. Medifast is the big one. I really want to hold on to Medifast, the position I have, and I don't know about adding shares right now. Maybe I'll add a little bit as it's really low, but I really want to hold on to Mastercraft, hold on to Chegg, and wait for these things to grow. I don't want to get rid of the shares and be frightened out of the positions. Flexible Solutions, I have liquidated some, and I'm going to be looking to liquidate more above $2 a share, maybe closer to $2.50 a share if I get that opportunity. I don't have that much in flexible solutions now, so that's the one I'm looking to liquidate. The others I would add to, but I want to maintain those positions, and I want to increase the quality, add more to the Google position, the American Express position, NVR, Cincinnati Financial, add those to the portfolio. And then I've got a foundation, a base where I can pour more money into the Mastercraft, the riskier stocks that we might see big turnarounds in the price. And that way I have a combination of undervalued and high return quality stocks, but they won't be super big gains. And then I can use those to harbor any of the temporary losses on the more risky plays and some of these smaller cap stocks. So that's my plan going forward. If you want to keep following along, subscribe, and if this video has provided any value, please give it a like. With that, I'll see you next time. Best of luck investing.